Investing in dividends is an excellent way to get monthly passive income. Unfortunately, this strategy's major flaw is that it frequently takes decades to see any real effects. But what if there was a way to use dividend income to retire sooner so you could genuinely take advantage of your youth? So in today's video, we'll talk about how to live quickly off of dividends. Please like this video and subscribe to our channel to see more fantastic material before we begin. Purchasing stock in businesses that regularly distribute dividends is known as dividend investing. This method has appeal since it offers a stream of income that is independent of the ups and downs of the stock market. Instead, dividend investors get regular payouts according to how profitable the business is. In retirement planning and during weak markets, this may offer a more consistent return that is appealing. One of the most well-known proponents of dividend investment is Warren Buffett. His methodical approach has enabled him to become a phenomenally successful investor. Therefore, dividend investing is a smart place to start for those wishing to follow in its footsteps. Your lifestyle and projected spending will determine just how much money you need to invest to live off dividends. The U.S. Bureau of Statistics estimates that the average American spends about $67,000 annually. This equals an average monthly payment of $5,600. Now, you might require more or less than this. Therefore, it's crucial that you modify this amount in accordance with your unique spending patterns. If you can control your spending, a little investment in dividend stocks can provide you with enough income to pay your essential living expenses, as well as some discretionary spending. Of course, your income will increase as your investment amount does. However, you might be shocked at how quickly you can truly accomplish this if your only objective is to retire as soon as feasible with dividends. Therefore, for the sake of this video, we'll use a yearly income target of $40,000, which should be sufficient to meet most people's essential living costs. Dividend investing is fundamentally a long-term strategy that calls for restraint and patience. To expedite the procedure and gain a step closer to financial freedom, you might employ two major tactics. Using covered call ETFs is one of the quickest methods to rely solely on dividends. Investors can receive income from dividends and stock appreciation using a form of fund called covered call ETFs. In addition to investing in stocks, the ETF also writes call options on these same stocks to generate extra money. Call options grant the buyer the right, but not the duty, to purchase a stock at a specified price within a predetermined window of time. Therefore, the ETF receives premium income that is distributed as dividends when it sells call options on the stocks in its holdings. Furthermore, since the ETF will be compelled to sell those equities if the stock price climbs above the call option strike price, there might also be capital gains earned. QYLD, XILD, and RILD are a few of the most well-known covered call ETFs. The appealing double-digit yields on these products are far greater than the yields on many typical dividend stocks. These covered call ETFs have yields of 15.96%. 14.18% and 13.76% over the past 12 months, respectively, for QOLD, XMOLD, and RILD. These ETFs have the advantage of offering income from both dividends and option premiums, resulting in a more consistent flow of passive income. These ETFs do, however, carry some risk because the stock price could drop or the options could expire worthless. So how much would you need to invest in covered call ETFs to retire? At the present yield levels, you would need to invest anywhere between $250,000 and $300,000 if you wanted to make $40,000 per year through covered call ETFs. Not bad at all, right? Particularly when compared to conventional dividend equities, where you would need to spend about $2 million to generate the same level of income. The second method for living off dividends more quickly is to put money into high-yield real estate investment trusts, or REITs. Companies called REITs invest in properties that generate income, like office buildings, apartment complexes, and shopping centers. These businesses frequently distribute a sizable portion of their profits to shareholders in the form of dividends. Omega Healthcare, Blue Rock Residential, and Apollo Commercial are a few of the top REITs for dividend income. These REITs have a strong track record of dependable dividend increases that give their shareholders a regular flow of cash. U.S. REITs have generated an average annual return of 10.8% over the past 20 years, according to CBRE Investment Management. Occupancy rates and market circumstances are only two examples of the various variables that might cause these yields to fluctuate. REIT investments are advantageous because they provide higher dividends than conventional stocks. However, because these businesses are more likely to be impacted by economic downturns, they also carry a larger risk. How much investment would you need to make in order to retire on REITs? You would need to invest about $400,000 if you wanted to earn $40,000 per year through REITs. The actual amount will differ depending on whether you diversify into several REITs or put all of your money into one, as this assumes an average yield of 10.8%. Realistically, you could use REITs to fund your retirement by making steady weekly investments and reinvested earnings until your portfolio reaches the size you want. By investing in REITs, one can attain financial independence in as short as 5 to 7 years with the right patience and dedication. The final thing to remember is that you should always have a plan when investing for dividends. You should be well aware of your financial needs as well as your objectives. By doing this, you may choose the stocks that are best for your portfolio and make sure that you keep to your long-term strategy. You must determine how much money your investments are producing in order to support your living expenditures. You could be able to get by on less than $40,000, or you might require considerably more if you have a family and want to maintain your preferred standard of living. It's also important to note that in contrast to traditional dividends, stocks featuring call, ETFs, and REITs frequently distribute shareholder dividends on a monthly basis. Due to this, both of them are now much more desirable options for investors hoping to profit consistently from the stock market. There you have it then. Financial freedom can be attained by making investments in businesses that produce solid, dependable returns on a regular basis. It's crucial to comprehend the risks involved with any investment, whether you choose stocks, ETFs, or REITs, and to create a strategy that matches your risk appetite. With a little perseverance, dividend investing can put you well on your road to monetary independence. How do you feel? Would you consider investing in covered calls, ETFs, or perhaps REITs? Comment below with your thoughts and let us know. As always, thanks for watching, and I'll see you in the future video.